All right, I might get us started. Hello, everyone. Thank you so much for joining us. My name is Naomi Hogan. I'm the company strategy lead here at ACCR, Australasian Centre for Corporate Responsibility. Thank you so much for coming along to hear about our research and analysis on Shell. I'd like to start by acknowledging country. Where I am, it is unceded land of the Awabakal people. And so I want to pay my respect to their elders, past and present, and pass on that respect to any First Nations people joining us today. So this webinar is really going to focus on our detailed analysis of Shell's energy transition strategy and also give you insights into our engagements with the company and our research on its lobbying activities. Please note that this session is being recorded, and we will give a copy of the presentation to everyone who is RSVP'd for this session and everyone who is attending today. And I note that there is a Q&A box available. We really encourage questions throughout. Pop your questions in at any time, and we'll have time at the end of the presentations to go through all of those questions. I'm pleased to announce our presenters today. We've got Nick Spooner, who's our company strategist, UK lead, and Sam Hall, who's our climate policy engagement analyst. And I'll now pass over to Nick. Thank you.
Thanks very much, Naomi. I'll start sharing my slides and get started. Okay, just a content slide. Okay, so we're going to be talking about Shell's strategy today, particularly their energy transition strategy, and the components to that, including the net carbon intensity, which is Scope 3 carbon intensity target. We think this target is not aligned with the goals of the Paris Agreement, and the company has made changes to water down that target over the past few months as they updated their energy transition strategy this year. A key component to Shell's energy transition strategy is a strong focus on LNG, with a particular focus on emerging markets. And we're going to go into some details around the fundamentals of that LNG growth strategy and where Shell believes that's coming from and whether that's true or not. There's been some changes to the company's remuneration structure as well, which also includes a new LNG volumes target in there, and takes away the previous NCI Scope 3 focus from the executive remuneration. And so this is really to help investors and to inform their voting decisions in the upcoming annual meeting on the 21st of May. We think this is going to be a particularly interesting one, partly because of the energy transition strategy and the cadence around that vote. So the company's moving from a vote every year. There's been a vote on the strategy every 3 years, which is the one for 2024, but also a vote on the implementation of that vote every other year as well. And the vote on the implementation is being removed. So this is the last opportunity for the next 3 years for investors to be voting on the company's strategy. And because of the changes in the company's target, particularly the watering down of the Scope 3 NCI target, we have concerns around the governance and oversight at the company. We saw last year with BP, many investors, I think 10 or 11%, voting against Helge Lund, the chair of the board, because of those changes and the sort of direction of travel of the company. And we would expect a similar sort of sign of dissent against the company. I think other considerations that go into that are obviously the Client Earth case and the mill defense case that the company is facing at the moment. And I already mentioned the remuneration. The final part of the company strategy that we'll be touching upon is their ambition to work with customers on decarbonisation as well. This is somewhat to absolve their own responsibility, but we think there's a lack of clarity around how they're doing this. And we think that the recent changes in the company's strategy sort of restrict the company's opportunity to do this as well. What would we like to see from the company? We'd like to see principally capital expenditure aligned with the goals of the Paris Agreement. This is not something that the company itself focuses on with regard to its own energy transition strategy, but what we want to see is a limitation or cessation of investments into fossil fuels with a particular focus on exploration capex, we'll be going into the details around Shell's exploration CapEx relative to peers in this presentation as well. And what that means is an alignment of commodity price assumptions and hurdle rates appropriate with a limited demand for fossil fuels in the future. We like the company to be reporting in line with the Greenhouse Gas Protocol. Divestments has been a big part of the company's strategy to date in terms of the achievement of its own energy transition targets, and we don't think that there's a credible strategy. We think any climate strategy should be actually contributing to a reduction in absolute greenhouse gas emissions, which we don't think Shell's strategy does currently. And then we'd like to see more detail around the company's lobbying activity, particularly in emerging markets. And we'll talk a little bit later around the engagement that ACCR has been having with institutional investors and the research that Sam has been conducting on the company over the past 6 or 7 months or so. As Naomi said, please feel free to jump in at any point with any questions. So just having a little look back at the company's votes over the past few years. So this is what I mentioned before, the energy transition strategy, and then the votes on the implementation of that strategy over the past few years. The votes on the implementation strategy have been a bit confusing for institutional investors in terms of how to interpret that. It is a little bit different from how other companies approach the Say on Climate mechanism. But what we've seen really is, I guess, a fairly consistent approach between the implementation and the strategy. And over the past 3 years, what we've seen is declining levels of support for that strategy at the company, with the last 2 votes being 2 of the lowest ever Say on Climate votes in terms of the level of support. That's based off of MSCI data. With the weakening of the company's targets, we would expect that trend to continue and probably exacerbate and increase in the 2024 AGM as well. We've already seen key investors such as MN come out publicly saying that they're planning on not supporting the energy transition strategy and supporting the Follow This resolution as well as Brunel signaling their discontent and lack of support for directors publicly. And MN is one of the Climate Action 100 leads, so this shows the lack of progress in that engagement and the discontent with the company as well. So just looking at Shell's strategy, I've already touched upon a few of these. The net carbon intensity target, which is a scope 3 intensity target. We don't think scope 3 intensity targets are very good in terms of demonstrating the whole picture around the company's decarbonisation strategy, because you can reduce your scope 3 carbon intensity while not reducing your absolute emissions related to the whole organisation, scope 1, 2, and 3. And this is to what's been happening with Shell as well. We'll go into the details of that. Previously, the company had a target for a 20% reduction by 2030 and a 40% reduction, 45% reduction by 2035. That was a big jump from 2030 to 2035. We didn't understand the fundamentals around how the company was going to get there. There wasn't very much detail around how the company was going to get there. It's very disappointing that the company has got rid of that target, because Shell works on a 10-year planning cycle. And so this strategy that would be voted in 2024 will be implemented in 2025. And so that 2035 target was particularly important because that was just coming into scope within the planning cycle for the company. The 2030 target has gone from a 20% reduction to a 15 to 20% reduction. So a small lowering of the level of ambition there. In our research that we put out in December, you can go on our website and find that. We show how we were concerned around how the company would meet that target, particularly on the back of the divestment of their European power business. And the company talks quite openly around the fact that reducing the NCI, the best way to reduce the NCI isn't by reducing fossil fuel production, but by increasing renewable energy power sales. The company has implemented a new absolute scope 3 target, but I don't want investors to get too carried away by that. That scope 3 target only covers their oil products, which is about 50% of their scope 3 emissions. research by third parties such as Zeller, but also by the company's own admission, demonstrates that the absolute impact on the company's total Scope 3 emissions is negligible or zero over the period of now to 2030. The company is aiming for a reduction of 50% in Scope 1 and 2 emissions. We'll go into more detail around sort of the divestment piece there and how that's contributed to the Scope 1 and 2 emissions reductions. One thing we don't go into detail here is around the company's clean energy investments, but what we've seen similarly to the NCI is a regression there in terms of the relative spending or relative capital expenditure on clean energy by the company, moving down from the 2023 CapEx figures to a lower range for 2024 and 2025. Yeah, it's also worth noting that Shell is at the lower end of European peers in terms of the relative CapEx on clean energy, so compared to Total, BP, and Equinor as well. Just to sort of take a step back to talk about the science here and to talk about the remaining carbon budget available. So on the right-hand side, you can see oil and gas projects, both operating and pre-FID projects. And then on the left-hand side of that graph, you can see the total carbon budget available to us. Shell itself has 5.3 gigatons of projects that it's developing, and the current total carbon budget that we have available to us is around 200 gigatons and around 250 if you include CCS and CDR as well. So we're fastly consuming that carbon budget, and this is just oil and gas projects, not coal projects as well, which obviously eat into that carbon budget very quickly as well. So what we're really trying to convey here is that the possibility for new investment in fossil fuels and oil and gas projects is the window's closed according to the IEA, or there's really limited room for investment in new fossil fuels, which goes against the direction of travel we're seeing in Shell's strategy in terms of this simplification and pivot back to increasing focus and investment on fossil fuel investments as well. I've already talked about this a little bit in terms of the new absolute Scope 3 target of 15 to 20% reduction in absolute Scope 3 emissions across their oil products only. And so the detail around the company's breakdown of Scope 3 emissions is not particularly clear, and this is the best we could do in terms of conveying that information to you. We would like to see better disclosure from the company around this, but this gives you a good idea of the scope or coverage of that Scope 3 target. There was a lot of pressure on the company around setting an absolute Scope 3 target. No pressure, as I understand, that target would just be contained to oil products. So we remain a little bit confused as to why the company would set a target that was so limited in scope and not in line with what investor expectations were. This could be, to those who are particularly skeptical, seen as a little bit of a box-ticking exercise to meet those investor expectations, but obviously in that context of the company's total Scope 3 emissions not declining by 2030 is a little bit tokenistic. The thing to sort of take into account here, and this sort of, we'll go into the details around the company's LNG strategy in more detail a little bit later, is that the company is increasing or targeting to increase sales of LNG by 20 to 30% by the end of the decade. And so that is really counteracting any reduction in production and sales of oil products as well. We've spoken about the NCI target and the removal of the 2035 target, in particular, that 45% reduction that was just coming into the 10-year planning cycle. This leaves investors with no information around what the company is going to be doing from 2030 to 2050, which is a very long time now. In terms of the sort of expectation around short, medium, and long-term targets, because we're getting that much closer to 2030, that is really being considered as a short-term target now. And so the company does not really have any medium-term Scope 3 targets or any guidance around how the company is going to achieve the rate of decarbonisation that it needs to between 2030 and 2050. What we show in this graph is that the level of work that is required from the company is that much harder now. So previously, for the previous energy transition strategy, there was going to have to be a doubling of the rate of decarbonisation between the period of 2016 to 2030 and the period of 2030 to 2050. Now that rate of decarbonisation is going up to 5 times. So a 5 times increase in the rate of decarbonisation relative to the previous strategy from 2030 to 2050. And for investors, there's zero clarity around how that is going to be achieved. And so that's pretty concerning and goes against what we think a credible energy transition strategy should look like as well. When you think about a marginal abatement cost curve, the cheapest available decarbonisation options at the bottom of that cost curve, and you'd expect those to be absorbed quite quickly. And then there's to be a longer tail of decarbonisation options that are higher cost, that as a society we have to bear, but that will take longer to decarbonise. And so we'd expect a faster decarbonisation at the beginning and slowing off towards the end. And what we see from Shell is the opposite of that, but also with no transparency or little transparency around how that's going to be achieved. Part of the work and part of the reason that the company's watered down their NCI target is that they've been divesting their European power business. So in the UK, Germany, and the Netherlands, this gives them a less avenue to be working with customers on their decarbonisation as well. The company was not, that part of the business was not profitable. It makes sense from a shareholder returns perspective, but from Shell's energy transition strategy perspective, it gives them less avenues to work with customers to decarbonise. They've also been reducing their downstream footprint in terms of divesting refineries as well, going down from over 20 refineries to around 5 right now, which also reduces those avenues as well. As it relates to oil and gas companies and their ability to make returns on clean energy projects, what we've been hearing from the sector is that vertical integration is really important. So working through the value chain and sort of taking advantage of their position through the value chain to achieve double-digit returns on clean energy projects. By Shell extracting itself from parts of the value chain, particularly the downstream part of the value chain, it reduces its ability to make those returns on renewable energy projects, coupled with quite high hurdle rates around its clean energy investments as well, which we can go into in a little bit more detail later. I've spoken a little bit around divestments. I'm going to go into some more detail here. Principally, the big takeaway for everyone on the call is that the company doesn't report in line with the Greenhouse Gas Protocol. The Greenhouse Gas Protocol is the standard around emissions accounting, and it's really important that investors are able to appraise companies based off of consistent accounting standards. It sounds pretty wonky and a little bit boring, but it has a really significant impact on companies' decarbonisation strategies, not just for Shell, but for other oil and gas companies as well. To take Shell as an example, 92% of its scope 1 and 2 emissions to date, reductions to date, so from 2016 to 2023, have been achieved through divestments. In this graph here, we look at things from a production and scope 3 perspective. And on that basis, we see a 12% reduction in production from 2016 to 2030. When we remodel that based off of applying the Greenhouse Gas Protocol to the company's accounting standards, we see a 26% increase in production over that time period. So you can see how that's a massive difference in the company's performance or how the company is perceived. And we're seeing this filter into investor assessments as well, in terms of, has the company been decreasing emissions over the past 3, 4, 5 years? Is that part of a credible energy transition strategy? And as it relates to the net carbon intensity figure, that is also the case. And we've done what we could to model that. And on the 2022 figures, the company had registered a 3.8% reduction in the NCI. And when we apply the Greenhouse Gas Protocol, so proper accounting principles to that, we see a 5% increase in the NCI from 2016 to 2022. Going to move on to the capital expenditure piece. Again, welcome any questions if there are any from anyone in the audience. I said I'd come back to the piece around exploration capital expenditure. I think the key point to take away here is that when oil and gas companies are conducting exploration or investing in exploration CapEx, the returns that investors are going to see from that are not going to be in the next 5 years. They're going to be sometime beyond 2035. Global Energy Monitor says 11-year turnaround on average between exploration capex and then returns associated with those projects. And so the IEA is already saying that there's no need for new investment in fossil fuels. That's whether or not that's the case really, or whether or not that's the case in 2025 or 2026, maybe sort of worth debating, but it's certainly not going to be the case in 2035. And so the rationale behind this high level of capex, and it is high relative to peers, what we see on average over the past few years is that Shell is about twice that of every other company. And that's not just smaller European companies like BP and Equinor, but also like Exxon, Chevron, Total as well. And this is not an immaterial amount of money. This is over 2 billion of capex per year. And so very material for shareholders. Some of you that have looked at Shell's reporting quite closely might have seen that the company does have a commitment around phasing out exploration capex in frontier countries. You might not have read the fine print on that the company's put out and what frontier exploration capex means. But what that means is that it's any exploration capex in any country where there's been no investment in fossil fuels by any oil and gas company. So not just Shell. That's an important point to stress there. So this is really most countries in the world. So we would question the sincerity or impact of such a target, and we would want to see from the company an immediate cessation of exploration capex. As it relates to commodity price assumptions, we've looked at this relative to peers. Not all companies, it's worth noting, report both oil and gas price assumptions in terms of their investment framework. Both for the company's oil price assumptions and for their gas price assumptions, we see them higher than peers. Shell on the gas front is the highest amongst the peer group that we could find. What you do here when you're sort of making such bullish assumptions is that you're increasing the modeled returns associated with those projects. And so if in reality the Henry Hub price is much lower than that in the future, the returns associated with those projects will be much lower and the profitability will be much lower associated with those projects. What we think a prudent approach to the energy transition would be taking commodity price assumptions that are consistent with declining demand, consistent with the goals of the Paris Agreement. And so a much more conservative approach would be to use lower commodity price assumptions. This is not what we see from Shell and is a big concern in terms of their overinvestment, particularly around liquefied natural gas as well. The company talks a lot about capital discipline. And so this is really surprising to see the inflated assumptions or optimistic assumptions from the company's perspective in terms of the returns expected from these projects. Coupled with that, what we see from the company is the lowest hurdle rates for fossil fuel projects. These have been coming down over time. So at the Capital Markets Day last summer, we've seen a decrease in the hurdle rates for oil and gas projects for the company. So when you think about the models that the company is using, they're using high pricing assumptions, and then the threshold for a project to be investable is very low. So they're setting themselves up for overinvestment in fossil fuels. And we see that reflected, obviously, in the executive remuneration that I'll come back to later in terms of the LNG volumes growth that the company is targeting as well. So in terms of capital discipline, or in terms of how we think rational behavior through the energy transition ought to look like, if we were doing sort of a mental model associated with this, we'd want to see conservative commodity price assumptions and then high hurdle rates to make sure that if there is a margin compression associated with oil and gas projects, associated with declining demand and a declining price and lower price environment, then the projects that the company is investing in will still be profitable under those declining demand situations. What we see from the company is completely the opposite of that, and is not an expression or representation of capital discipline at all. Just to quickly refer back to the piece around renewables, we've seen declining investments from the company year over year in terms of their renewables investments. And what we see in terms of the application or manifestation of the company's new focus on capital discipline is that's really being applied to their low carbon projects rather than their fossil fuel projects. This obviously creates a lot of risk for shareholders in terms of their overinvestment in fossil fuels, particularly on the gas front. So where is this coming from when we think about these sort of LNG forecasts? And Shell do an LNG outlook every year in terms of giving details around what they think the future of the LNG markets is going to look like. On the right-hand side, you can see a graph taken from the 2024 LNG outlook that Shell put together. I'll apologize on their behalf for it not being very clear, for being grey on top of grey, but the top grey bar is their demand forecast going out to 2040, which is around a 50% increase from now to 2040 in LNG demand. What you can see with the red line and the green line are the IEA scenarios, so the IEA net zero emissions scenario and the IEA all policy scenario as well. Also on there is a Wood Mackenzie scenario, one net zero emissions scenario. All of those fall well short of what Shell's expectations are. And yeah, there's a big disparity between what independent energy analysts are saying and what the company is saying as well. So we have been looking at this, and this is one of the things that has drawn our attention over the past year or so, and we've been wondering sort of where these assumptions are coming from and what are the foundations for their beliefs in this bullish demand growth for LNG, because this target for them, both in the remuneration but also in the increased sales of LNG over the next few years, is going to be predicated off of these assumptions as well. One thing we hear from the company, and this is a sort of common narrative that we hear from many oil and gas companies, is around coal to gas switching, particularly in Southeast Asia. What we show here on the graph is that really the story around the energy transition in the power sector is not one of coal to gas switching, but of coal to renewable switching, with gas playing a marginal role in system balancing. What we've seen over the past few years, and there was a very interesting quote from the Asian Development Bank recently, is that many of the countries within Southeast Asia that did have a reliance on natural gas were very hurt by the recent commodity price volatility and the high gas prices over the past few years as well. And so many of those countries have been put off future investments in gas because of the energy insecurity, ironically, that has been caused by their investments and reliance on natural gas production within those countries, in places like Pakistan and Bangladesh, which have faced blackouts and severe economic impacts because of reliance on fossil fuel imports. Renewables are becoming increasingly cheap year on year, and they're really going to be the energy choice that is going to be the most profitable for these countries, but also providing energy security as well. One of the other narratives we've seen from the company recently is around coal to gas switching in the industrial sector. The example that the company puts forward in the LNG outlook in 2024 is around coal to gas switching in the Chinese steel sector. On the right-hand side of this graph, you can see Shell's representation of what that will look like in the next 30 years or so, in terms of the role that gas will play in terms of the decarbonisation of Chinese steel. On the left-hand side, you can see the original research that is taken from, and how Shell has relabeled many of these categories to give an overinflated sense of the role of gas in the decarbonisation of the Chinese steel sector. This is obviously not a reasonable representation, and we did the thing that probably Shell ought to have done in terms of speaking to the NGOs that authored this research, and they were not pleased with the company in terms of how this was being represented. It's also, when we think about gas, in the steel sector, this is obviously not a long-term solution. It's not a net zero solution. And there are much cheaper available technologies such as electric arc furnaces or direct reduced iron in terms of producing zero carbon steel as well. The singular, I think, carbon capture and storage projects associated with a steel plant is capturing around 20% of emissions and is not profitable and is not being replicated in other cases, with a stronger focus on hydrogen and a stronger focus on electrification in the steel sector as well. And we could go through many other heavy industries and give similar examples of where gas will not play a role. Energy security is another one that I mentioned. I've already given the examples in Bangladesh and Pakistan of the energy insecurity that is being caused by a reliance on fossil fuel imports. Clearly, a reliance on cheaper renewables where there's less import dependency. You're not relying on flows, but relying on stocks is a much better way to build energy security. And if Shell was being sincere and honest in terms of the pursuance of energy security, then it would be making much stronger efforts to be investing in renewables rather than in fossil fuels as well. And we see this to be true in terms of the emissions reduction story as well. There's a lot of, or an increasing discussion around Scope 4 emissions and avoided emissions. We haven't seen any evidence from the company that coal is being displaced, to go back to the slide a couple of slides ago. And what we see instead is that any sort of gas generation is adding on to coal and only increasing emissions rather than displacing any emissions. So we think that that's problematic, and we think that more evidence has to be presented if the company is going to claim that emissions are being displaced and that coal to gas switching is part of a net zero energy transition as well. It's worth noting, and this is an IEA graph around future LNG demand. What is expected from the IEA is that there's a lot of projects that have gone through FID that are under construction right now, and they're going to cause an oversupply of LNG in the coming few years. So from 2025, 2026 through to 2030. And that oversupply is going to cause prices to crash, similarly to what we saw in the sort of 2019 period in terms of the low utilization of liquefaction and regasification infrastructure. Yeah, it's worth noting that the IEA, with all of its scenarios, both the STEPS, All Policy Scenario, and NZE, sees an oversupply based off of those projects that are already under construction. And they take into account all of these narratives or the rhetorics or the assumptions that I spoke about earlier in terms of coal to gas switching, and both in power but also in industry, and they still come out with vastly different conclusions to the company as well. One thing that you might be thinking is that, okay, but Shell has a big trading arm, and that is going to allow it to sort of smooth sort of the impacts of the energy transition by reducing the risk associated with overinvestment in upstream assets. But what we see from the company, and Shell is one of the big aggregators of LNG, it's the biggest LNG trader globally, it likes to make a lot of noise about that, is that the company has more offtake agreements than it does sale agreements. And so what the company is doing through this is overexposing or increasing their exposure to downside risk associated with the spot market. And so what you can imagine here is that Shell has all of these offtake agreements, but then if prices were to decline and demand were to decline, their exposure on the spot market would be higher. And what they're doing by having a greater weighting of purchase agreements to sales agreements is assuming that prices will go up in the future. Finally, just to touch upon remuneration, and I've talked about this already a little bit, they've taken away the NCI target that we've spoken about lots already from the LTIP, and they've included LNG volumes into the bonus scorecard as well. The focus has shifted from Scope 3 emissions to operational emissions, and so not really related to the company's overall decarbonisation strategy at all. So we think this is a concern for investors, particularly around the volumes growth that doesn't take into account returns-based metrics like return on capital employed or other hurdle rates related metrics as well. I just wanted to talk about our engagement quickly before I do hand over to Sam. So we've been engaging quite intensively with the company over the past 6 or 7 months, really on the back of some amazing research that Sam has been doing that he'll go into in a second around the company's lobbying activities in emerging markets. At the beginning of the year, we filed a shareholder proposal in conjunction with a couple of institutional investors. And we've been engaging on the back of that around sort of how the company could meet our expectations. Last week, we withdrew that resolution based off of a commitment that the company has made, which has now been made public. It was made public last Friday, committing to the company around how it will expand its disclosures around lobbying in emerging markets. This doesn't meet the full ambition of the resolution, and we're going to be continuing to engage with the company on this issue, but we think it's a really good start in terms of the company's recognition about the importance of this and the role that plays in terms of their future strategy as well. So now I'll hand over to Sam to go into more details around that research.
Thanks very much, Nick. Hi, everyone. My name's Sam Hall. I am a policy engagement analyst here at ACCR, and yeah, I'll be walking you through our research into Shell's lobbying activities and disclosures that supported that engagement. Now, essentially what our researchers unearthed and highlighted is that Shell doesn't substantially disclose its lobbying activities in emerging markets. In fact, its disclosures are mostly or almost exclusively focused on activities in advanced economies. So as a result, that means investors are in the dark about how Shell is influencing climate and energy policy in markets that are actually very material to its forward strategy. And that's both on a business front as well as on climate. So if you look to the right, that chart there shows that over half of production by Shell through to 2050 is expected to come from emerging markets. That is using IMF definitions of emerging markets and very granular data that's come out of Rystad. And as we've already touched on, Shell sees emerging markets, particularly in Asia, as key drivers of LNG demand going forward. So both on the supply and demand side, its activities are very, very material in emerging markets. So clearly, by largely omitting emerging markets from its lobbying disclosures, those disclosures are not at all in proportion to the company's activities or its ambitions going forward. Our researchers also found a range of lobbying directly by Shell as well as through industry associations to promote fossil fuels in ways that risk locking in fossil fuel consumption in these emerging markets at levels that could be at odds with Shell's own support for the Paris goals and, of course, its decarbonisation strategy. So this lack of disclosure, I think it's important to also note, is also despite Shell's own commitments to transparency on lobbying. It regards itself as quite good on this front. It's also committed to report and assess material lobbying where it does significant business and has influence. And yet we're just not seeing that at all in emerging markets. Yeah, so on this slide, we just highlight some of those key findings in terms of that asymmetry in the disclosures. So again, Shell's lobbying disclosures are almost exclusively focused on advanced economies. When it comes to industry associations, they are absolutely exclusively focused on advanced economies. So on the chart, the bottom left there, you can see from the left-hand column that Shell only reviews industry associations that are based in advanced economies, none in emerging markets. Whereas our research, using just publicly available information, was able to find at least 80 associations that were relevant, engaged in climate and energy lobbying that Shell hadn't disclosed. And then more of half of those were in emerging markets. And in many of them, Shell holds influential leadership and governance positions, and I think can very fairly be seen to have influence and be a material part of the business. From the chart on the right, you can see that Shell also only discloses its aggregate lobbying spend. There are kind of different methodologies between jurisdictions, but that aggregate spend that gives investors an impression of its intensity and activity in lobbying and political influence. It only discloses those figures in the EU and the US, where it's required to. So essentially lobbying spend elsewhere in the world, i.e. in emerging markets, as well as many other advanced economies, is somewhat of a black box, essentially. I'll go to the next slide and talk a little bit about some examples of what we found in our research. Very much encourage you to check out the report that we've written that provides a lot more range of examples, but also detail. But just to spotlight some here, we see a range of lobbying activity that appears to risk that misalignment with both Paris and Shell's own decarbonisation goals. Here we've just highlighted some examples from across Asia. So Shell has important leadership positions at influential associations across the region, which are lobbying to promote gas and risk creating and locking in excess demand for it going forward. So Malaysian Gas Association, for example, it really just consistently overstates the climate credentials of gas. I think it's quite indicative of the kind of policy that it is lobbying for. Shell is a founding member, council member, and this association is saying that, you know, gas is the cleanest source of energy, or that it's necessarily good for the environment just because it's supposedly somewhat cleaner than other hydrocarbons. In India, quite interestingly, we saw both Shell and this major trade association, Federation of Indian Petroleum Industry, really lobbying in very similar ways in parallel to create new markets for LNG in transport, to incentivize gas production through GST breaks, quite explicit about that, and promoting coal to gas switching, as has been mentioned, with very little climate context or comparison to renewables, a very big focus on air pollution alone. And then finally there, I've noted quite a few jurisdictions across Southeast Asia, you know, Vietnam and Indonesia, Philippines, Thailand, and so forth, where we also see a fair bit of activity and where Shell has been open about its strong interest to establish and grow LNG import markets, and where it also has a reasonable amount of access to policymakers, but also important state-owned enterprises and so forth. That kind of brings me to my next point on the following slide. Just touching on the second row first, Shell really also appears to have quite a lot of direct, high-level access to policymakers in emerging markets, and it also doesn't assess this systematically. So, you know, just a couple of examples here to give a snapshot. In the UAE, just in the lead up to COP28, Shell co-authored scenario sort of sketch of the UAE's energy transition together with the Ministry of Energy. At COP28, Nigeria seemed to be seemed to have invited Shell executive to join its negotiations and support Nigeria's policy platform called the Decade of Gas. And then in China, Shell has stated elsewhere that it was influential in shaping China's critical 5-year planning process on promoting gas as sort of a mainstream energy source by working with the state council. But we see no systematic appraisal or documentation of how the company is engaging in China, which is such a critical market to it. In that first row, I also note some examples from supply side lobbying. I touched on demand in the previous slide. We see, similarly direct and industry association efforts to boost investment in exploration and production, with a really big focus on economic benefits and often very little climate context. So Shell holds leadership roles at influential industry associations in each of those countries. I've put in bold there, and more. As I mentioned, we have lots more examples and details in the report that we've put out, so I encourage you to take a look at that. And then finally, to the next slide, just to sort of round up, I think it's important to note that, you know, we believe this lack of transparency on emerging markets lobbying by Shell really increases risk for investors, because essentially it keeps them in the dark about advocacy that risks that fossil fuel lock-in, and that in turn is not aligned with company decarbonisation commitments, as well as those commitments to transparency. So, you know, we're concerned that emerging markets lobbying is also potentially driven by Shell's exposure and bullishness to LNG as the largest private trader and key revenue source for it, above many of its competitors. And that lobbying push, that push to shape countries' approach to the energy transition is sort of motivated by a bullish strategy that doesn't really appear aligned with climate goals. Finally, I'd also like to note that we believe more transparency from Shell is needed, also from that just transition perspective. So as the World Bank and the UN and others have noted, but yeah, quite notably in a landmark report at the end of last year, growing energy demand in emerging markets, which is essentially what Shell is banking on, can be a driver of corruption, which can then weaken policy responses and in turn exacerbate those inequalities, those climate inequities between the global north and the global south. So the chart here to the right, what we've got is bubble size. There is Shell's forward production size through to 2050, again based on the Rystad data that we've analyzed, and then the color of the bubbles represents corruption risk as measured by Transparency International's Corruption Perceptions Index. Obviously, red is higher risk and green lower. And what's very plain from that map is that Shell is exposed to higher corruption risk on average in these emerging markets. So certainly something that I think investors would benefit from understanding when going into those engagements. I think an extra level of transparency and care is required around that. That is all from me. So thanks very much. And I will hand it back to Naomi and obviously open up the floor for questions.
Thank you so much, Sam, and thank you, Nick. There was a lot to get through there. We now do have time for some questions, and I encourage anyone, if you haven't yet, but you're working up a question, do pop it into the Q&A box. We are also available to take further questions after this. Please be in touch with us. We will follow you up with an email to give you a copy of this recording and answer any further questions that do come up as you look through the research. I've got one question here, and I'll start with you, Nick. And look, you've given a few examples, but perhaps you can summarize. What would you say to investors who generally take the position that Shell is a leader when compared to its peers around disclosure and decarbonisation?
Yeah, I think first of all, when we think about climate risks and the risks that investors are exposed to, the important thing is to note that these are absolute risks that the company is exposed to. And so any company that is over-investing in fossil fuel infrastructure is going to be impacted by the energy transition when demand decreases and prices associated with that demand decrease as well. And so the way in which we think companies ought to be assessed is based off of their alignment to the goals of the Paris Agreement, particularly around their capital expenditures I mentioned, rather than relative to other peers that might also be doing poorly in terms of their disclosure as well. What we do see from some of the larger cap companies is obviously they are better resourced and able to do better in terms of their disclosures. Notably, companies like Exxon still perform well in assessments like the TPI and MSCI as well. There's obviously attraction to using that big data in terms of integrating that into voting principles, but that misses the absolute risk that you as investors may be exposed to. And so that, I think, would be the thing worth noting there.
Thank you. And another question on NCI targets across the board. Is there a role for them in the transition plans of oil and gas companies?
Yeah, it's a good question. I think there is a role, but I think the NCI targets shouldn't take as much primacy within decarbonisation strategies for oil and gas companies as they do. They seem to be the principal targets that companies are sort of pivoting their strategy around. As I mentioned, they don't necessarily sort of lead to a reduction in absolute emissions, and that's the risks that we're concerned about, both from a systemic perspective, but also from a company level perspective, from an idiosyncratic company risk perspective. And they're easily gamed. So a company, and this has been done by oil and gas companies, if a company buys some retail renewable energy power company, they massively increase their renewable energy sales and massively decrease their NCI, but the impact on the climate has been zero through that acquisition. So we have to be careful too around organic versus inorganic in terms of how these targets are being achieved as well. But ultimately, what we need to be seeing is a disciplined approach to capital expenditure, which is what Shell talk about, but focused around fossil fuel investments and constraining investments in fossil fuels that are not going to be required in the energy transition and in a net zero scenario as well. And so we think that that capital investment framework is the most important piece, followed by absolute Scope 3 targets, followed by net carbon intensity targets. The way to think about net carbon intensity is that it's really just a proxy for how much investment or sales they have from clean energy versus dirty fossil fuel energy.
Thanks, Nick. A question here around, in order to gain a better understanding of the greenhouse gas protocol point that you made earlier, can you provide a little bit more on that? The question here, oil and gas production has increased at the facilities Shell has not divested. Can you talk more through what the greenhouse gas protocol requires in terms of divestments?
Yeah, absolutely. So when companies divest, there's something called rebasing, and this might be getting too technical. But what you're meant to do when you're divesting those assets is to take away the emissions that are represented as that divestment to occur, so that you can show your current emissions footprint based off of a sort of longitudinal picture of what the company looks like, rather than these emissions reductions or changes being impacted by acquisitions or divestments. So this can work in both directions here. So you're basically meant to normalize that based off of what your current business looks like. And so what we've seen in terms of the company's divestments is that the company has divested assets that would continue to produce oil and gas beyond that point, and so would have led to increasing production over time, whereas what we see from the company is a reduction in production over that time, and the disparity there is very significant.
Thank you. And shifting gears a little to China and India, a question here. Considering that India and China are price sensitive, what do you say to their argument that though the LNG price is likely to fall due to the supply glut, it will be supported by these economies?
Yeah, this is actually something that we've heard from Wael Sawan, actually, the CEO, and he has been saying that some of their demand forecasts are based off of the fact that prices will fall, which goes against what we spoke about earlier in terms of the commodity price assumptions as well. Basically, there's some inverse logic being used here in terms of the demand destruction that was caused by high commodity prices from 2021 to 2023. We've seen those prices come off in 2024 as well, around a 50% reduction in the last since the beginning of the year, and we haven't seen a commensurate increase in demand associated with LNG. So we think that there's been permanent and structural damage to the LNG demand market in places like India and China as well. You see in places like China that they have caps around reliance on LNG and and a preference for piped natural gas and produced natural gas in China, but really trying to not rely on gas as a fuel in general and relying more on increasing investments in renewables as well. So what we would expect to see from those countries in particular is a reduction in that price sensitivity. Sam, I don't know if you have anything to add because you've been looking at this closely as well.
Yeah, sure. I can add a couple of small points. I think in East Asia, China, but also Japan and other East Asian countries, you're seeing increasing trend toward re-export. They're feeling oversubscribed. And as Nick has mentioned in China, that piped gas and domestic gas is really the focus from an energy security perspective as well. And then looking over to South and Southeast Asia, I think there's quite a lot of good research coming out now that's showing that demand elasticities for energy types are becoming much more complicated, precisely because of this disruption to the LNG market and that sort of volatility affecting forward planning and an increasing look toward renewables as a more secure but also a lower carbon footprint solution. So yeah.
Brilliant. Thank you. All right. Well, we are well and truly at time. Thank you, everyone, for joining us. To reiterate, we will send through a copy of the recording and are available for more questions and meetings. So thank you very much for joining us, and we hope to see you again soon.